Hello and welcome to the IME webinar about the importance of building an investment mandate. For those of you who have joined us before for our webinar, hello, I am Shagun and I will be moderating this session today. Very often, people who are investing or want to invest are overwhelmed with the problem of too many options. Where do you begin and what happens next? This is where your investment mandate comes in. This is a written document that becomes a strategic blueprint of how you would like your finances to be managed. Taking us through the specifics of how an investment mandate works is Ashi Anand, founder and CEO of IME Capital. His experience of 23 years in fund management has given him the tools to understand and then explain to us how to efficiently use an investment mandate to move investors from confusion to clarity. In today's webinar, Ashi will be using a demo client persona and taking us through the step-by-step process in building an investment mandate, all the time while using the IME proprietary RMS. Just one thing before we start. We will be taking questions in the latter half of this webinar, so please type your questions in the chat section and I will get to them as soon as I can. For now, let's get started with Ashi. Hi Ashi, welcome.
Great, Shagun. Thank you so much for the introduction, and thank you everyone for joining today's webinar. Today's webinar is a very, very important topic. Very often we have investors come and ask us, what is the best investment? And we always respond with there's no right answer to that. You really need to understand portfolio construction, and that does require certain foundations, and that is really where the whole investment mandate is about. So let me just actually jump right into the webinar. I'll just give me a minute. I'll just share the screen. So starting firstly with what is an investment mandate? So an investment mandate is a written document that helps clearly spell out your unique requirements, providing a strategic roadmap of how you would like your investments to be managed. It helps narrow down this very large universe of fund categories to the fund categories that are best fit to your specific needs. Now, what is the specific problem statement and what is it that the mandate helps address? This is really a short sample of the kind of range of investment options that exists for an investor. An investor has to choose between different fund structures, asset classes, and different categories before even getting down to the specific funds that they wanted to invest in. Just to kind of give you a bit of an indication of this complexity, right? These are apart from the structure, a mutual fund, a PMS, or an AIF. What are the asset classes? And within each asset class, there are different kind of categories. Which of these are relevant for an investor and how does an investor choose? And these choices need to be made before you get down to actual fund selection. Now, this is just a kind of a snapshot of some of the funds that are higher rated funds on our platform. And if you just look at the sheer number of options, this complexity is something which can be overwhelming. And how do you really solve for that? That is really what an investment mandate does. So the process of an investment mandate is really about taking an investor's financial goals or financial plan to help understand the right asset class, taking their risk profile to help identify the specific categories within that asset class that are the most relevant, taking incorporating the preferences and beliefs to kind of include or exclude certain specific categories of funds, and then finally having a very clear fund rating methodology or fund selection methodology to ensure that only high quality funds are entering the investor's portfolio. The whole aim is to take an investor from this complexity of way too many investment options and towards clarity. So if you just look at this from 5 asset classes, 40 categories, 4 to 5 different structures, and 2,500 funds, how do you really go about to get to what we believe is the way most portfolios need to be constructed? A few asset classes, 3 to 4 or max 5 categories, a few structures, and about 5, 10 funds that you actually identify. So the investment mandate is really this process that helps you move from this level of complexity towards clarity around the asset classes, categories, structures, and funds that you need to incorporate as part of your portfolio. Now, what is the importance of an investment mandate? A mandate basically helps you shift from transactional investing towards a more strategic investment plan, towards away from unsuitable investments that may not meet your requirements, towards kind of investments that are very optimized towards you as an investor. Without a mandate, very often we've noticed investors are investing with limited awareness of the entire range of investment options. With a mandate, investors really understand the pros and cons of each, and it helps move from what can be a suboptimal portfolio towards a highly bespoke and tailor-made portfolio to your specific or unique needs. So that is just the background of a mandate. Now, what we will be doing is going through the kind of investment mandate step by step, each step, and kind of helping explain how each step helps narrow down the range of options towards the specific options that are the most suited for your requirements. So let us first start with the importance of a financial plan and how it is linked to the right choice of an asset class. Now, the first important element is that a financial plan is relevant for all types of investors. For an individual, it helps answer important questions such as how much do I need to save and can I meet my most important financial goals? For a retiree, you're helping answer how much can the retiree spend and how long is the money likely to last? For ultra HNIs, where your amount of wealth may have moved well beyond kind of meeting goals, is really trying to understand is your portfolio optimized and how do you really protect your wealth and legacy? And for corporate treasuries, right, are your corporate goals being funded and do you have corporate stakeholder buy-in? Investors' goals would differ depending on the type of investor that they are. But there is always an importance of a financial plan giving you kind of clarity over what it is exactly that you're trying to do with your money. Now, for the purpose of this webinar, we will be taking the example of a specific type of an individual and kind of using that as a kind of a framework to help you show how you kind of use the financial plan, risk profile, etc., to narrow down. But everything that I'm indicating is actually true for every one of these type of investors. The process remains the same. The requirements is all that's really changing. So starting with kind of a financial plan, right? And why is it important to have a financial plan? Now, the main point with financial planning is that very often without a financial plan, investors can very often underestimate the impact of longer term goals. What happens with goals that may be 10, 15, 20 years into the future, these become very easy to ignore in the short term. And because of the impact of inflation, these goals could prove to be very difficult to meet in the future. Just to give you kind of an example, expense of 20 lakhs today won't be achievable in 30 years down the line. 20 lakhs may seem achievable today, but a 1.5 crore number may be something quite difficult, right? And that is really where the importance of actually planning for this in the future, because inflation can really play a lot of havoc with the cost structures. Now, how do you mitigate inflation? And this is really where the power of compounding comes in. The same 1.5 crore goal 30 years down the line, right? Which is a 20 lakh expense cost as of today, which may be 1.5 crores in the future. If you invest 2 lakhs today and it's compounding at kind of 15%, 2 lakhs would actually become 1.5 crores. And if you see a much smaller investment, because of the power of compounding, it actually meet really large, substantial goals. And this is where it becomes important to invest less by starting early. The earlier you start investing for your goals, the less you have to invest, because the power of compounding really actually helps ensure that you can meet much more aggressive goals over the longer term with much smaller investments at this point in time. Now, why is this important? We have done this time and time again whenever we have looked at kind of creating a financial plan for investors. You've constantly kind of noticed that one, not only are some of your goals very lumpy in terms of overall size, but they also tend to be kind of come all together. So you have both very large expenses such as retirements, your kids' education, the purchase of a house, very often all coming together at later stages of your life. This can make it very difficult to plan for unless you have planned in advance. And this is why what we have tended to see quite often is families in their early 30 to about 45 could be in a state of financial complacency where income is well ahead of expenses. A lot of your major goals are far away, and therefore that criticality of planning is not something which is that evident. However, the moment you kind of get into this 45 to 60 age bracket is very often when you have a combination of both your kids' education, kids' marriage, with an upcoming retirement, right? And this is where you suddenly start feeling a certain level of financial pressure. And people really tend to underestimate just how much they need for retirement. Just to give you context, when you are for your retirement context corpus is needs to kind of be enough to meet 20 or 30 years of expenses at much higher inflated levels of cost. Having clarity on what exactly these numbers are and planning for them in advance is very, very important to ensure that you can meet the goals that you have set out for yourself and for your family. Now, the type of financial goals can vary quite significantly. There are a combination of shorter term goals. Now, this could be a contingency plan, a piggy bank plan, travel funds, etc. There could be medium term goals such as the purchase of a car or purchase of a house. And there are longer term goals, which are retirement, child's education, marriage, etc. Now, on the IME kind of client portal on the app, you effectively what you do have is the we have financial planning which is completely integrated in. So you can sit and you can define out your specific goals that you have, understand when they're likely to hit in the future, what these costs are likely to be, and allocate your current investments to specific goals to understand what level of funding you have against each one of these goals. And this is something which we believe is extremely important because ultimately investments are not about achieving 1 or 2% higher in terms of yields, but investments is always needs to be looked at in the context of what it is that you're trying to achieve in your life, and do you have visibility of being able to achieve those specific goals. Now, when you are building a financial plan, it is very important to understand a few things. And this is not a financial planning webinar, it's an investment mandate webinar. We probably have a separate financial planning webinar where we go into some of this in much greater detail. But a few important things to keep in mind. One, financial plans take time and effort to build right. In our experience, it probably takes a minimum of an hour to create a financial plan. Secondly, members can have different aspirations. It is very important to take into account the aspirations of all the different family members. Many things may remain unknown, right? At the time of building of, sorry, just give me just 1 minute.
I think Ashi was having some network issue. He will join back in no time at all.
My apologies, I'm right back. So when you are building your financial plan, you are not going to have visibility about a number of things. You probably don't know what college your child is going to go to. You probably may not even know the field of study. You don't know when you're going to retire. There are many, many assumptions that you have to make. It's best to be conservative in making these assumptions. And again, this is where a private banker and a deep consultation with a private banker helps understand what are the choices that you're making here. Now, there are different goals, and different goals could have different levels of priority. Very often, when building a financial plan, you may kind of realize that not every goal is achievable at the same time. And which is where having a prioritization of goals, understanding which goal is needs to be met first over the others, becomes really important. Another mistake that we've noticed very often investors making is taking the current annual expenses and actually using that as an indication of the expenses post retirement. And this can be absolutely the wrong thing. There are lots of adjustments that need to be made to what your expenses are as of today to what they're likely to be at retirement. Another element is that money is fungible. It can move between goals. So if you overplan for a goal, that's great because you have extra money that can be used for other goals that you may have. But if you're short of money, that could be a problem. And unplanned goals can very often derail your plan. making money come out of your existing goals. These are just some of a snapshots of some of the things you need to take into account when building a financial plan. And it is very important that you take the time and the effort to do this right, because this really gives you the blueprint of how you're going to achieve some of the more important things that you wish to achieve in your life. Now, from an investment mandate perspective, the reason a financial plan is very important is a financial plan gives you proper visibility over your investment horizon. Effectively, there are two core asset classes of debt and equity. And debt is meant for capital protection, while equity is meant for capital growth. Debt is the right asset class when you have shorter term goals, and equity is the right asset class for your longer term goals. And that is really where, from a portfolio construction perspective, a financial plan is extremely important, because you need to have clarity over which asset classes you're choosing based on your investment horizon and your financial plan. Now, the core here, right, and the reason this is so relevant is the way the risk reward in equity changes dramatically over a period of time. In the short term, this is a 1 to 3 year investment horizon, equity can be highly risky. But as you go into the longer term, equity as an asset class becomes almost risk free. We have done a comparison of kind of returns of the Sensex over the last kind of 20 years and compared kind of the range of returns for different holding periods. And what you effectively see is a very high level of volatility in the nearer term. But as you go into the longer term, equity becomes virtually risk-free. Now, 7 years plus is typically, from a market perspective, considered to be the average length of an economic and a market cycle, giving enough time for good, okay, and bad years to really average itself out. And this is effectively what we're trying to kind of help with kind of financial planning and linking the financial plan to the choice of asset classes. If you're looking at kind of the last 25, 26 years returns of the Nifty, the moment you have longer term goals, you can really take advantage of this longer term compounding that equity markets tend to move up over a period of time. The moment you also have clarity that this investment I've made is being made for a goal which is 10, 15 years away, it helps manage emotions in weak markets. And it also helps you meet larger, lumpy goals with much smaller periodic investments. Your shorter term goals are now, the moment it comes to any shorter term goal, you want to avoid the temptation of investing for that goal in equity. Because if you had invested, say, for a goal which is 6 months away, a year away, year and a half away, tempted by much higher equity returns, and you do go into a period where kind of markets correct, there is the risk of a forced redemption in a weak market, and which is where this kind of bifurcation, short-term goals should always be in low-risk asset classes, and your longer-term goals should be kind of invested for in equity or a higher risk asset class. And this is effectively what the framework is. Shorter term goals, lower risk asset classes, the longer horizon that you go, you can take much greater allocations to equity where market volatility doesn't really impact your emotions or your larger plan. Now, just kind of going back to this demo client that we had kind of taken, and if we look at the financial plan, this client has a combination of kind of the need of a contingency fund, which is an immediate kind of a goal. You have a daughter's education, which is coming up in the near future. The son's education coming up kind of in the medium term. And then you have these longer term goals of retirement, the home purchase, daughter's marriage, etc. Now, this is where, and what I am showing you is the process of building the mandate out on our equity RMS on the client portal. If I am looking at the kind of choice of asset classes in the context of the goals, I do need debt to fund these kind of immediate short-term goals. There may be a requirement of certain hybrid asset classes to meet that medium-term goals, and equity is clearly the right asset class to meet these kind of longer-term goals that you've set. We much prefer asset allocation being driven by this kind of goal planning as compared to very often in markets you'd hear these kind of templates If you are 40 years old, you should be 80% in equity. If you're 60 years old, you should be 40% or 20%. We believe those are highly simplistic and are not the right way to look at asset allocation. Asset allocation really needs to be looked at in the context of your investment horizon and how long you really have to really plan for your goals. Now, that basically covers, right, financial plans and how that helps determine the right asset class. Shifting to the risk profiling, right? Now, while the choice of asset class is driven by your financial plan, your risk profile helps you choose the specific subcategory within an asset class. Now, just to understand what your risk profile is, risk profiling is basically the process of understanding an investor's risk capacity and appetite when making investment decisions. It's a behavioral assessment that combines financial analysis to determine the level of market volatility an investor can emotionally and financially endure. It is very important to understand that there are two very distinct types of risk profiles. There is one, your risk appetite, which is a behavioral assessment which assesses the risk you are willing to take. But there's something which is completely different, which is your risk taking ability. This is a capacity assessment and it analyzes the risk you are able to take. Often, an investor's risk appetite and risk taking ability can actually conflict, can be completely separate from each other. And this is why it is very important to measure both of these separately. Now, what is risk profiling, right? Now, risk profiling is not about avoiding risk. It's about taking the right kind of risk in the right amount and at the right time, helping you ensure that your asset allocation is aligned with your risk capacity and tolerance. It prevents kind of mismatch expectations by avoiding investments that are outside your risk tolerance. And it supports long term investing by promoting discipline across market cycles. There are, like we kind of mentioned earlier, there are different types of risk profiles. So there's broadly kind of three categories: conservative, balanced, and aggressive. They can also be very conservative or very aggressive. Now, the risk appetite, right? How you behave in terms of volatility, what levels of volatility you're comfortable with, the risk capacity, right? How strong your cash flows are, how secure your income is, other such elements, and other such behavioral traits. All of these come together to really understand these two levels of score and help build. So you get two separate scores, a risk appetite score and a risk taking ability score, which helps you build a composite score, helping you identify what your risk profile is. And that risk profile helps kind of determine for each asset class what are the specific categories, right? So it's even for a conservative investor, for a longer term investment, equity is the right choice. It's just a choice of equity. A conservative investor may focus on large cap and larger mid cap, while your more aggressive investors may be more mid cap, small cap, and more aggressive categories um, within kind of equity. Now, just to understand this in slightly more depth, what we will kind of just go through, and we'll go through this fairly quickly, is what are the kind of options that you have in each asset class and how this really aligns with your risk profile. Now, again, we will be using the demo client as an example. And for now, we'll kind of just assume that this demo client has done the detailed risk assessment questionnaire, right, to help understand the risk profile. And this risk profile has turned out to be aggressive. Now, if you're just looking at kind of equities, right, and within equities, there are different types of market capitalizations. They're larger companies where your revenue growth, institutional shareholding, and volatility tends to be a lot lower, but they also have lower kind of growth characteristics than kind of mid and small caps, which have much higher growth potential over the longer term, but they come with a greater degree of volatility, both in terms of the share prices as well as the business models. And they also have kind of lower levels of institutional shareholding, levels of corporate governance are often also not as high. Now, what happens is that your more conservative investors may be more aligned towards large cap. You have kind of these multi kind of classes, large and mid caps, multi caps, flexi caps. These categories basically give you a combination of large, mid, and small in your portfolio. And you have kind of pure mid cap and pure small cap funds, which may be suited more for more aggressive investors, as well as thematic and focus funds, which again may be more suited for more kind of aggressive investors. Now, just to give you some context of this in terms of returns, what we have done is we've taken kind of the relative performance of large, mid, and small over the last 25 years. And if red is basically the small cap index, green is the mid cap index, blue is the large cap index. What you do tend to see is that in strong market environments, so if you're seeing the bull market between 2002 to 2008, the subsequent kind of post NDA coming back to power, 2014 to 2018 market rally, the market rally post kind of the post the COVID lows, uh, your small caps can actually, smaller mid caps can deliver much higher returns. But in the subsequent market corrections, when markets turn, you can actually see them give up a very, very large part of their overall returns. Now, this is something that you want. So, what happens is that apart just from your risk profile, timing your entry into kind of the more aggressive asset classes, small and mid, can be extremely important because in kind of weaker markets, their ability to kind of fall very significantly is very high. Now, this is where kind of that combination of the investor's risk profile and the combination of the current underlying market environment is what helps you choose what equity category is right for you. Now, we had kind of said that we are going with this kind of investor, demo investor, and we've said that aggressive is the kind of risk profile that this investor that has been evaluated at, and which is where kind of we probably go with categories such as a flexi cap and a large and mid cap. We'd probably stay away from pure, more aggressive mid cap and small cap. Now, again, this is mid cap and small cap relevant or not for an aggressive investor. Again, it really comes down to the level of aggression that the investor has. Um, just give me 1 minute. Now, coming down to, so that explains equity and how do you choose the categories within equity. A similar choice needs to be made when you're looking even at what is perceived to be lower risk, which is kind of debt or fixed income funds. It's not that all debt funds are similar. You have a combination of lower risk kind of debt funds. Now, these are either lower duration and funds that invest in papers of higher of more credit worthy borrowers, or you have higher risk kind of debt investments. These either are much longer in terms of the duration of their holdings, making them a lot more sensitive to interest rate fluctuations, or they kind of lending to riskier borrowers. We will not spend too much time on debt because what has happened is that in 2 to 3 years ago, the government changed the kind of underlying taxation on debt funds. And with debt funds now being taxed at the same rate as the income tax slab of the investors, they really aren't as tax efficient. In fact, what we have done is for the vast majority of our investors, for the incremental lower risk investments, you're kind of moving them towards either arbitrage or equity savings. Now, arbitrage is basically a fund category very, very similar in risk return to these very low rate, very low risk debt fund categories. However, they actually benefit from much superior equity type taxation. So if you're looking at a similar return, 7.5% on a short-term debt fund versus an arbitrage fund, your debt funds may be taxed 39%, while your arbitrage funds are really being taxed at 12.5% plus surcharge, etc. And we've taken the highest kind of tax slab here. If you're looking at the difference, 4.5% versus 6.3% for the same pre-tax return, the difference in taxation is what makes arbitrage a lot more suitable than debt funds for investors going forward. Now, equity savings funds, investors who are willing to take on a slight level of risk, right, is where equity savings fund, which is a form of a hybrid fund, which invests in a combination of debt, equity, and arbitrage, really can become quite attractive. If you're just looking at the returns these categories have delivered over the last decade, you've really seen neither of these categories actually deliver a negative return, and you'd almost never expect that in arbitrage. Equity savings, because you have 66% in lower risk arbitrage or debt securities, will also not give a negative return, unless you have a year where equity markets fall by more than 15 to 17%. Um, Between arbitrage and equity savings could kind of give you, well, arbitrage funds could give you 6 to 7%, equity savings could give you between 7 to 9%, because of this boost that you get from kind of the equity component which is there. The right choice again really comes down to a consultation or discussion with your private banker. But just kind of going back to kind of our example where we are building out this mandate, the investor did have the need for a contingency fund that is best kind of built via arbitrage. And in terms of these kind of goals that had been identified, right? Goals 2 years to 5 years down the line, perhaps equity savings may actually make a lot of sense. Now, running through kind of some of the other alternatives which are there, you have hybrid funds, and within hybrid funds basically invest in a combination of debt and equity. You have funds where the equity component can shift based on fund managers' choices. You have aggressive hybrid as a category, which helps reduce the kind of level of volatility as compared to a pure equity fund. Equity savings, according to us, is a very interesting alternative to traditional fixed deposits or debt funds. And you have conservative hybrid, which I think is probably no longer as relevant, because by just taking a slight level of higher aggression, you can move towards much superior equity taxation on an equity savings hybrid fund as compared to conservative hybrid. Now, out here, because there was this kind of relevance of these goals 3 to 5 years down the line, we are kind of choosing equity savings for this particular investor. Now, this is something else which is a very important kind of a discussion, right? The different structures, a mutual fund versus a PMS versus an AIF. We don't really have time to delve in great detail in terms of the different choices of structures. But just to kind of let you know, this is something which is a very, very important choice. Within equity, you have a choice between an equity mutual fund and equity PMS and equity AIF. Which should you go with? There are a lot of nuances, but effectively, mutual funds are a lot easier to manage in terms of operational. It's also a lot easier to do systematic transactions on. They are also a lot more tax efficient, where mutual funds, you only tax on redemptions, while in a PMS and an AIF, you're effectively paying taxes every year. It's not that you're paying more taxes. In a mutual fund, all taxes get bunched together and paid at the time of redemption. In a PMS or AIF, you're actually spreading the taxation out. You're paying taxes each year. But what happens is that in a PMS and an AIF, there are a couple of important elements, which is where we believe that the quality of management is a lot superior. Now, the biggest thing here is when it comes to high quality firms where you have a high quality owner manager. What we mean by owner manager is where the fund manager is actually also the principal owner of a firm. What we have noticed in these boutique owner manager, higher quality boutique PMS and AI firms is that you have much more tightly defined investment philosophies, a much higher degree of style specialization, with firms focusing on a few specific kind of strategies, levels of differentiation being higher. And just broadly, the quality of management, according to us, is superior when it comes to a high quality owner managed PMS. Now, this becomes all the more relevant when you just look at the sheer level of kind of uh, drift away, or the sheer migration that is happening away from mutual funds towards kind of the very best fund managers in the country, basically leaving high quality funds to set up their own boutique firms. You've seen the CIOs of some of the largest firms, right? Be it Nippon, be it HDFC, Axis, Kotak, multiple of the best quality talent are all going to set up their own firms. And this is because ultimately most fund managers would prefer running their own boutique fund where they have much greater control over the investment philosophy, the investment styles. And if you want to be with what we believe to be the better quality talent, that is really where I think that value of a PMS and AIF comes in. Another element is we have kind of done a study and we've compared kind of longer term returns of a PMS and an AIF. And even the kind of average PMS has tended to outperform the average mutual fund. And this has been before this kind of large drift away of the highest quality talent that we've seen. And which is why we believe that this trend of outperformance of a PMS or AIF over mutual fund could actually only just accelerate in the future. And as you get very selective about the choices of funds, this the level of outperformance could actually be that much higher. Again, kind of going down to this construct of a mandate, this is where we're kind of saying that, okay, fine. The investor may choose to invest in PMSs. AIs with a 1 crore limit, perhaps for this investor may be too high. And they may want a certain amount of mutual funds for the operational simplicity of systematic transactions, etc. Very often, what we do is investors do their SIPs via mutual funds, and the annual bonuses may get invested in a PMS or an AIF. So that's the kind of choice of a structure. Now, there are also a very large amount of alternative investment options. Investors can choose between unlisted equities, long short funds, debt AIFs, asset yielding funds, real estate funds. Most of these alternatives only open up to investors at a minimum investment of 1 crore and above. And these also are a lot more sophisticated in terms of the level of complexity and the relative risk reward. But for investors who have larger corpuses and who do kind of understand investments a lot more, some of these could be quite kind of relevant. Right now, again, the app really helps you sit and choose which of these alternatives you really want to focus on. For this particular investor, we'll actually not choose any of these alternatives. A last point is that when it comes to the investment options, is that there is really no reason for you to have all your investments concentrated on in a single economy and exposed to a single currency risk, right? And which is why for a lot of our investors, we do actually recommend investing a certain amount of their portfolio overseas. There are a very large amount of options available in terms of international investment options. You have choices of specific kind of region or country specific funds. There are specific themes that you may choose to kind of want to invest in where you may not have exposure to these themes in India. And you have kind of a large amount of asset classes as well. We do have a dedicated Singapore structure to make it a lot easier for investors to build international kind of allocations, and the choice between investing via Singapore using a feeder fund in India. There are pros and cons of each of those. Again, that's something your private banker can help you choose. But I think kind of international allocations are something which are quite important. Now, very often this is also your financial plan may also come into account here. The investor, as you see, does have an aspiration of sending their child overseas, right? And when the moment you have an overseas education, you are exposed to currency risk, and therefore perhaps a certain amount of global equity, right? And now, which global equity? Let's just say because they're planning to send the child to the US, a certain amount of US diversified funds and US debt tech funds. And because one of the goals is a bit closer, the daughter's education, which is 2 years away, a US debt fund, which is investing in kind of short duration US treasuries, may be something which is again quite relevant. So, this effectively, right, is the process of how you kind of use the plan, you use your risk profile, right, to shortlist from this entire range of categories towards, if you see the specific structures, asset classes, and the categories that are the most relevant for a particular investor. Now, the reason this is important is that when you are sitting and trying to kind of go through all these range of investment options, Without a mandate, you are sitting and struggling with this complexity, right? While we do have kind of filtering, you have to choose between so many structures, asset classes, categories, it can really get very overwhelming. However, on the app, the moment a mandate has been built, you will once see, okay, these are based on everything that we've discussed. These are the specific categories that are the most relevant for the particular investor. You are seeing only the kind of returns of those particular categories. You aren't kind of overwhelmed with too many options. And when you are kind of discussing funds with your private banker, we have this option called mandate funds, and I'll show you another place you can go to this from, where you will now only see the structures, asset classes, and categories that you have identified as being relevant for you. The other kind of options do not come in. So it helps ensure that your investments are only happening in funds that meet your particular mandate. Now, coming down to the last couple of points, right? The financial goals and your risk profile help determine the asset class and the category and help reduce this complexity of dealing with too many categories and too many asset classes. Now, there is an important overlay of certain preferences and beliefs that you have. And what we've still not answered is that once we've shortlisted a category, how do we choose between all the different funds in that particular category? So now first just sticking to the kind of beliefs and preferences and its impact on portfolio construction. A lot of this really comes into what are the kind of funds you are looking at. The different investment styles, active, passive, or hybrid. There are different return orientations, absolute return focus versus relative to a benchmark. The different types of equity styles, there's different types of liquidity preferences. There's different levels of complexity that an investor may be comfortable with. There's sometimes certain ethical filters that may be relevant for certain types of investors. There may be certain themes that an investor is interested in investing in. And there may be certain behavioral preferences. All of these basically get captured as part of a discussion and help identify within a particular category when you're looking at different funds, which is the kind of fund that the investor would prefer to go to. Now, the last element around the kind of getting down from this complexity of 2,500 funds towards the 10 or 15 funds that meet your specific requirements is how do you identify there are 20 flexi cap funds. How do you identify the flexi cap fund which you should invest in? Right. And this is really where kind of our fund selection methodology comes into play. At IME, we have our own kind of proprietary rating methodology, which we use to analyze both asset management companies or the firms that manage these funds, as well as the specific funds that they provide. Now, this is a very, very stringent kind of methodology that we have. When we are looking at where we're trying to assess an AMC, we're kind of looking at the AMC's quality, the level of size, their pedigree, their ownership, the relative strengths and weaknesses across AMCs, the investment team, what's their level of experience, what is their focus, what's their past track record, right? As well as fund level checks in terms of the funds that they are offering. And we have analyzed over 250 AMCs, and there are only about 40 of these 250 firms that we've analyzed that meet our criteria in order to be 4 or 5 star rated. When it comes to kind of a fund, we evaluate the value of the strategy, the level, the relevance, the level of differentiation, how closely the strategy is actually being followed, the level of scheme age, and how this fund has really performed across market cycles. Right? A fund having done very well over the last 3 or 4 years is not relevant. You want to understand how they performed in terms of consistency over a period of time. Looking at the team, looking at the fund manager, looking at the AMC quality, and this is really what helps us shortlist from this very large amount of schemes towards kind of like we said, there are only about 185 schemes of almost 2,000 firms schemes that we've looked at that kind of meet our selection criteria. Now, one very important element, and this is, I think, a place where IME is unique in the industry. There's no other firm that does this. Typically, this kind of fund rating methodology, every wealth management firm would have some way of analyzing what are the funds that they want to kind of recommend to the investors. But that selection criteria and how they've looked at specific funds, that is something which kind of is kept hidden or opaque on a platform, right? When as an investor you have sat and you've shortlisted, and with a private banker you are now sitting and trying to identify specific funds. If you go into FlexiCap, right now FlexiCap as a category, these are some of the funds that we are recommending. If you click on any particular fund, you would actually sit and our rating criteria, the way we look at these funds, right? For every one of the criteria, what is the specific rating that we've given? What is it that we liked or we didn't like about that fund on that criteria? Our views on the fund, right? And these are our written views of our research team. It's not copy paste of marketing material. It's not algo driven. These are our kind of insights into this particular fund. How the fund, what the team is, how the fund has performed over a period of time, all of that information is made available so that every single investor is kind of seeing the same single point of truth on a fund. And this is effectively where kind of based on various preferences, right? And this is where the private banker is sitting with the investor. You've shortlisted FlexiCap, but within FlexiCap, what are the funds? We've chosen PMSs and mutual funds as an option. Based on various discussions, we may narrow down to, okay, fine, let's do these two funds from a FlexiCap. In a FlexiCap, let's do, say, one fund in large and mid cap, and within kind of arbitrage, we need, let's say, one fund for the kind of contingency fund. And we also have the US debt fund for the investors, kind of for the daughter's marriage. For that, we could kind of go with a shorter duration treasury bond fund and one US diversified fund, and say a tech fund to kind of give the investor exposure to this very fast growing tech sector. Right. So I know we've covered a large amount of ground today, but when we did kind of, this is effectively how we build portfolios at IME Capital. Portfolio construction is driven by this investment mandate process, where the investment horizons determining the asset class, the risk profiles determining the category. You take into account the kind of beliefs and preferences, a very clear fund selection methodology to identify the funds, make whatever adjustments required based on the market environment. And what this basically results in, if you remember at the start of the conversation, we had this one slide here where we spoke about moving from kind of complexity to clarity, right? 2000 funds, too many categories, etc. If you see for this particular investor that we've kind of used as demo investor, we have shortlisted the structures, the asset classes, and the categories to specific categories that meet the specific requirements. And basis that, we could actually use and go into each category, understand each of these funds, why they've been shortlisted, understand which of these meet the specific preferences and beliefs of a particular investor, to sit and shortlist and identify the kind of 5 or 10 funds that meet that specific investor's requirements. And that effectively is what the investment mandate process is. Um, Thank you all so much for a very patient kind of hearing. I hope this helped clarify how we go about with portfolio construction. Just wanted to kind of close out by just indicating that we do offer for anyone who's on this webinar a free 30-day trial, right? For anyone who's kind of not an existing client. Now, this free 30-day trial gives you complete access to this proprietary IME RMS that I was using through today's webinar. There would be a dedicated private banker who would be assigned to you, who would help build a free financial plan, build your mandate, and do a comprehensive review of your existing portfolio. or to help you really understand what is the way that we recommend you go about uh, building and constructing your portfolio from a more strategic, thought through, longer term methodology. Thank you all so much for such patient listening. And Shagun, over to you for any questions and questions that people may have.
Yes, Ashi, you do have a few questions. I'm going to get started with Shamir's question, who says one of the issues with investing in global equities is related to the safety of the investment as it is not governed by the Indian law. So, how can it be convinced for an investor? How can this be convincing for an investor?
Okay, actually, that is a really relevant question, right? And when you're looking at kind of international investing, you have to be very careful about the kind of structures that you use, the kind of funds that you go into. International investing can be extremely easy and extremely safe. You have mutual funds in India that give you kind of global exposure. There's sometimes a problem in terms of are they available to invest or not, because very often these funds close for investments. But these are absolutely kind of very, very easy and virtually no different from the way you invest in normal Indian mutual funds. You have our Singapore structure, for example, is extremely kind of, it's very, very tightly governed. It's governed by the Singapore Monetary Authority, considered to be one of the most stringent regulatory authorities in the world. We only invest in some of the highest quality fund houses. So the funds we'd recommend would be the BlackRocks, the Fidelities, etc. of the world. So as long as you're careful about the structure and the mode with which you're investing internationally, it's actually really not that complex or that different from Indian investing. One very important thing the moment you're looking at international investing, since a lot of investments does tend to be kind of US focused, if you invest directly in a US domiciled fund, any investments over $60,000 can expose you to estate duty risk, where 40% of your assets above $60,000 will get taken away by the US government in the case of the death of an investor. Now, you can completely avoid inheritance tax by being careful about the domicile of the fund that you're investing in. You can get the same US tech, US diversified exposure by investing in what's called a SICAV domicile fund. That is a fund which is domiciled out of either Ireland or Luxembourg. You use that structure, you're getting the same US exposure, but with no inheritance tax. I think a short answer to the question is that as long as you're careful about how you're doing it, international investing can be extremely easy and very, very low risk, similar to kind of what we're investing in India.
Ashi, a related question. How does the current tariff and political situation in the world impact investment plans in the near future? I have some more questions, so after
Sure.
this.
So now, this is where we speak about portfolio construction. Where we have spoken about the asset class selection, the category selection, specific requirements, the kind of IME fund rating methodology. If you see this, a market environment. Market environments are dynamic and are constantly kind of changing. Now, in the context of kind of, you currently have uncertainty around the level of growth in India, you have uncertainty on tariffs. There are always going to be certain underlying uncertainties. I've been investing in the markets for over 25 years now in a professional capacity. There's never been a year where there's not been some big issue or uncertainty or the other. You need to look at this in the right context, make adjustments to the portfolio as required. So, for example, one important adjustment that we currently have at IME Capital is that given the sheer level of outperformance of small and mid caps in the recent past, combined with a relatively weak near term economic outlook, we are quite cautious about small and mid cap exposure, even for investors with a higher risk appetite. So it's really kind of US tariffs are just one of many factors that you really look at when you are building portfolios. But the market environment is a very important kind of overlay that you do need to have when building out the portfolio.
Ashi, Linus wants to know about the gift city options in mutual funds, domestic and international, for NRI investors.
Sure. So basically, when it comes for NRI investors, and I think there is GIFT, there's also a Singapore structure. You can invest both in India and globally. via either of these options. Both of these are highly regulated, both of these are fairly secure. We believe that the Singapore regulatory environment has had much more time to mature than GIFT, which is where we have a slight preference at this point in time for Singapore over GIFT. But I think ultimately, what is a lot more important than GIFT versus Singapore? Both of these give you both of these alternatives. You want to understand what is the firm and what is the fund that you want to invest in and which structure this is available in. So that I think so gift versus Singapore is I think more than gift versus Singapore, it's which fund you want, how does that meet your requirement, and where is it available from? And very often, the best quality funds may be available locally. So, if you want India exposure, it may sometimes be better to invest directly in an Indian fund as compared to Singapore or kind of gift if you want the highest quality fund. Now, again, then the type of NRI becomes very important. If it's a UAE investor because of the double taxation avoidance treaty, where mutual funds are kind of can be tax exempt, mutual funds may have greater relevance for investor in the Middle East as compared to a PMS or an AIF. But if they're a US investor, it's a polar opposite because of the complexity of TFIC taxation. PMSs are a lot better than mutual funds or AIFs. So I think again, these are nuances. It's important that these are thought through well. And that's really where our private bankers come in. And that's really where it's a one-on-one consultation to ensure that you kind of build the portfolio, keeping all of these considerations in mind.
Ashi, Ram is asking what your opinion is on SIFs and REITs.
Okay, so these are two very different options. SIF, I think it is just way too early. I would very, very strongly recommend investors to not get caught up in the hype. You need to wait for SIFs to mature. These are likely to be slightly more complex investment funds. You do not want to be the first set of investors investing in a new investment team, in an investment team that has not yet stabilized. There are a lot of things that need to come together for a fund to really perform well over the longer term. Clarity on this emerges over some period of time. Just because something is new is in our we normally recommend investors to stay away from something brand new and very kind of hip in the current market context. Let things stabilize, understand how the team is performing over different market cycles. So for SIFs, we think it's too early. As some of the funds get launched, we will be evaluating them, but we mostly recommend investors to wait a bit. REITs is something that really an investor needs to see in the context of REIT is a decent alternative to kind of an arbitrage or an equity savings fund. It is slightly more complex than either of the two, but for the right investor, I think it is quite a decent option for their fixed income allocations.
Ashi Shamir wants to know why AIFs are more risky than PMSs.
Actually, they are not. Right? AIFs are of a very large amount of different types. Let me just see if I can just um, so if we just kind of go to the RMS, right? And if you kind of filter down on AIFs, you've got certain kind of AIFs which are very, very low risk, right? So there's this category called absolute long short, which is actually a fixed income. It's an alternative to a debt fund, alternative to equity savings. These are actually much lower risk than your PMSs or mutual funds, than equity PMSs or mutual funds. But if you kind of look at a kind of a the true alternatives, right? Your unlisted funds, your higher yield debt AIFs, some of these may have a higher level of risk. It is not an AIF is only a structure. It's got nothing to do with risk reward. You need to understand the type of AIF to really understand what is the level of risk reward that you are dealing with.
Fair enough. Ashi, Chetan wants to know if we can share some model portfolios for different risk appetites, depending on the amount of investment and the stage in the, life of the investor.
Yeah, so Shagun, again, this is something which definitely can be done. We do have, Shagun, just confirming my screen is still visible, right?
Yes, it is.
Yeah, I think some of you would already be in touch with one of our private bankers. So if any of you are in touch with a private banker, you can just get in touch with them. They can share that with you. But if you're not, just WhatsApp us on this number. We will put you in touch with a private banker, and they can help kind of share this with you.
Okay. Ashi, Shamir also was asking for Gulf-based NRIs, what kind of investment strategies in debt fund is considered good, given that there's no tax for FDs?
For NRI investors, when you are kind of looking at some of the NRE fixed deposits, which can be kind of tax-free, um, and where conceptually the level of risk may be not very high, especially if you're investing with a decent quality bank. I think those fixed deposits can be quite competitive. However, if you want things like a US Treasury fund, like we believe one of the most attractive investment opportunities right now globally from a low risk perspective is going into a longer duration US Treasury fund. There is current uncertainty on tariffs and the impact that can have on inflation. But if you kind of just look at it from a longer term perspective, yields are likely to fall. You have a combination of a 5% yield to maturity with with the potential for kind of capital gains. You have the potential on some higher duration US debt funds to possibly kind of make 7, 8, 9, even a 10% kind of a dollar yield on a US Treasury fund. So I think again, it really just comes down to risk appetite, requirements, etc. And which is why, at IME, we really strongly believe that portfolios need to be tailor-made and customized to the needs of a specific investor. There is never a one-size-fits-all approach.
Um, okay, I thought you might say that, Ashi. Tej is asking, I have already built my financial plan and the risk profile. Is this not the same as the mandate? And if not, what is the difference?
Oh, thanks, actually, Teja. That is a very important, that is a important question, right?
Yes, I thought so
Yeah.
too. Yes.
So if you're seeing the financial plan and the risk profile is just part of it, right? It gives you clarity on your horizon, it gives you clarity on the profile. What we have noticed, and we've noticed this with even large investors, right? HNIs and ultra HNIs that we've dealt with, who've been investing for the last 10 or 15 years. As part of our investment mandate process, we are actually sitting and taking investors through each of the different options that exist. Now, very often we've noticed investors may not be aware about the fact that there's something called absolute long short and the relevance that may have for a lower risk portfolio. They may not have understood that an arbitrage fund is really as safe as a short duration debt fund or bank fixed deposit. They may not have understood that equity savings can be looked at in a particular way. Uh, the Our mandate process basically takes investors through this entire bouquet of options to ensure that the narrowing down is happening in a structured manner in consultation with the investor. Now, when you are sitting and just doing a financial plan and a profiling, this entire process that we walk through, this is not done. In our experience, investment mandates are built for kind of ultra HNI individuals with some of the much larger private banks. But this is common for kind of investors 25 crore plus. But in the normal HNI, the affluent, and some of the other segments, this is something which is virtually never done. You're only doing risk profiling, you're only doing financial planning. That's only halfway kind of down the journey.
Ashi, Chetan has another question. Investing in international funds between Singapore and Dubai, which is better, presuming that these jurisdictions have no CG and hence are better than the US or the UK?
Shagun, sorry, can you just repeat that?
Sure. He's asking about whether investing in international funds between Singapore and Dubai, which one is better? Because you presume that these jurisdictions don't have any CG and therefore they might be better than the US and the UK.
Okay, so again, right, I think, and this is something that we do kind of notice quite often. There are different, let me just see what we can use here. Um, there is different asset classes, the different categories, and the different structures and the different jurisdictions. I can sit and buy a Nasdaq fund domiciled out of the US. I can have it domiciled out of Luxembourg or Ireland. And these are typically the places you like to have funds domiciled out of. There are few kind of countries or jurisdictions which are popular for funds to be set up. When you're investing via Singapore, or you're investing via Dubai, or you're investing via GIFT, or you're investing even say in India, these are just routes to invest. Ultimately, that fund, right? If you're investing in a US fund, and if the US were to tax capital gains on foreign investors, which it does not do, you would be taxed regardless whether you were in Dubai or whether you were in Singapore, whether you were in Luxembourg or where you are. So that choice of, are you doing it from Dubai? Are you doing it from Singapore? Where are you getting better access? Where are you getting the better quality funds? And especially if you're investing, you're almost never going to be investing in a Dubai fund. There's no major market in Dubai to invest. Or you may invest in Dubai into a US fund. You need to be very careful that it's not domiciled in the US. Now, if you're getting a non-domiciled US fund with the right kind of thing sitting in Dubai, that may be the right approach. Doing from Singapore may be the right approach. The capital gains tax set is not really going to change one way or the other.
I think we have addressed most of the questions, Ashi. There are a couple of questions. I'll do one very quick last one. Tej has asked, does the mandate change over time and how often it should be reviewed? We'll keep this as the last question.
Okay, sure. Yeah, so a mandate does definitely change over time, right? And if you're looking at just the way we have defined the mandate, goals are never static. Aspirations change, requirements change. We've noticed risk profile of investors also change. Either their appetite may change or the risk-taking ability may change. Someone may be in a very secure job. They may have left that to start their own company. Suddenly, the risk-taking ability can shift quite significantly. Preferences and beliefs can change. The underlying way you look at a fund and what's a high quality fund may change tomorrow. It's constantly kind of evolving. The mandate kind of needs to be looked at. So at IME, we have a very clear kind of there's an annual detailed review. There's also a half yearly review. There are a lot of reviews that are constantly happening. And as required, as situations change, the mandate changes. The mandate is a living, dynamic kind of an object which changes as requirements change. It is not meant to be something which is static.
I think we can close this out here, Ashi. You've answered a lot of questions. Thank you so much. And to everybody else who joined us on this Thursday evening, thank you so much. We do a lot of these webinars, so we'll be happy to keep sending you invites for our future sessions. Please get in touch with someone from the team, and we will ensure that you know about the next time this is happening. Thank you so much, Ashi. Um,
Thank you. Thanks so much, Shagun. Thank you everyone for attending and hope you found the webinar interesting.
Thank you. Good evening, everyone. Bye bye.